Hi, I'm Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. This is part two of my video series on the Federal Reserve and mortgage interest rates. You'll recall in part one, I said that the Federal Reserve does not have direct control over mortgage interest rates. When you hear in the news that the Federal Reserve has raised rates or lowered rates, they're talking about the federal funds rate, not mortgage rates. The federal funds rate is the rate that banks and financial institutions lend money to each other. That kind of impacts the cost of money these days. So the Federal Reserve uses that rate to control the economy. If it thinks the economy is heated too high, it'll use that rate to slow it down or to speed it up or to bring inflation under control. All these things the Federal Reserve tries to do with the federal funds rate. But mortgage rates are not directly tied to that. So when you hear that the Federal Reserve has raised it or lowered it, that doesn't mean interest rates, mortgage rates have gone up or going down. In fact, we have a direct evidence of that. The last time that the Federal Reserve changed the federal funds rate was way back in August of 2023, almost a full year ago. And since then, we've seen a steady increase in mortgage rates, tapering off, sort of stabilizing in the last several weeks, but still rates fluctuate every day. And the Federal Reserve rate has not changed since August of 2023. So they are not tied together. Mortgage rates are dependent on investor confidence, investor sentiment, how they feel about the way the economy is going. Is it going good? Is it going to stay going good? Is it going to get better? Is it going to get worse? Is it better to put my money in the stock market or the bond market? Those kinds of things are what drive mortgage rates, especially what's happening in the bond market, because mortgages are bought and sold as bonds on the bond market. So that's where mortgage rates come from. They do not come from the Federal Reserve. And that's why it's very difficult to predict what mortgage rates are going to be, because you're predicting how people are going to impact and how people are going to invest their money in the stock market or in the bond market, because that's what will ultimately determine mortgage rates. So it's not the Federal Reserve. It's way fuzzier than that. I wish it was more direct, but it's not. It's just this big conglomerate of how do investors feel, and are they feeling good? Are they feeling nervous? And what do they want to do with their money? That's where mortgage rates come from. If you have any questions about that, you know how to reach me. I'm Jeff Spolstra with Summit Mortgage, and this has been Mortgage Points.